institutions on the planet. You're hearing the headlines: markets plunge, recession fears spike, BlackRock halts withdrawals. But let me tell you what's actually happening, because the headlines are designed to sell clicks, not to save your portfolio. What just exploded isn't just debt. It's the illusion of safety that Wall Street sold you for the last decade. It's the belief that the music would play forever. And now that the music has stopped, the game of musical chairs is exposing who's actually sitting on solid ground and who's been balancing on a stack of IOUs held together with hope and low interest rates. This isn't a correction. This is a repressing reality. And here's why this moment matters more than anything you've seen since 2008. The bomb that just went off is buried inside the machinery that most retail investors don't even know exists. BlackRock, Vanguard, State Street, these aren't just companies. They're the plumbing of the global financial system. When they have a problem, it's not their problem. It's your problem. It's your 401k. It's your children's college fund. It's the stability of the banking system that holds your deposits. And right now, that plumbing is backing up badly. The debt bomb isn't just government debt, though that's bad enough. It's the $1.7 trillion wall of private credit, commercial real estate loans, and leveraged buyout debt that was packaged into beautiful, rated, safe products when money was free. When interest rates were zero, none of this mattered. You could roll over any debt, kick any can down any road, but rates aren't zero anymore. They haven't been for a while, and the can just hit a brick wall at highway speed. Here's what you're about to crack open in the next few minutes. I'm going to show you exactly how this mechanism works, why the big funds are now trapped, and most importantly, what happens next. Not what the talking heads on television guess will happen, what actually happens based on the mechanics of how money moves when fear takes the wheel. I've been inside these storms before. I've seen the floor of the trading room when the screens all turn red and the phones stop ringing because nobody wants to pick up and admit they're trapped. And I'm going to tell you what I'm watching right now, what makes this moment different, and what you need to understand before you make a single move. Because the worst decision you can make right now isn't the wrong trade. The worst decision is making any decision based on fear instead of understanding. If you're watching this and your stomach just dropped because you saw your portfolio take a hit, or you're sitting on cash wondering if you should jump in because everything looks cheap, you need to hit that subscribe button right now. Not because I need the number, but because your future self will thank you for the foresight. On this channel, Dimon, we don't just tell you what's burning, we hand you the fire extinguisher and show you where the exits are. We break down the machinery so you can see the gears turning. And in a moment like this, understanding the gears is the only thing that separates those who get crushed from those who walk away with their capital intact and eventually their wealth multiplied. Let me take you inside the mechanism, because this isn't abstract, this is physical. When I was a young banker, long before I sat in this chair, I made a mistake that cost me a year of my life in stress and lost sleep. I thought the crash was the noise. I watched the ticker, I read the news, I thought the panic selling was the event. I was wrong. The crash isn't the event, the crash is just the system resetting. The real danger, the one that bankrupts families, destroys retirements, and forces people to sell their homes, is staying frozen in the headlights afterward. It's not understanding that the market doesn't move in straight lines. It moves in cycles of greed, denial, fear, and capitulation. And right now, we're moving from denial into fear at a speed I haven't seen in years. Here's what just happened with the debt bomb. Imagine you're running a massive fund. Imagine you're running a massive fund. You've bought billions in bonds, in private loans, and assets that aren't traded on an exchange. They're marked at a certain value on your books. Everyone agrees they're worth that value because the market hasn't tested them. It's like your neighbor's house. You assume it's worth what Zillow says until someone actually tries to sell it. Now, interest rates go up. Suddenly, those bonds are worth less. Those private loans look shaky. The commercial real estate backing them is sitting half empty. The value drops, but you don't have to admit it yet because you're not selling until you have to sell. And that's the trigger. When investors get nervous and start pulling their money redemptions, they're called, you can't say, sorry, I'm not selling. You have to raise cash. You have to sell something, and you don't sell your worst assets first. Nobody wants those. You sell your best assets, the liquid ones, the ones someone will actually buy. This is called selling the gold to pay for the garbage. And when enough funds do this at the same time, the gold drops in price too. Now everything is falling, the good, the bad, the ugly, all of it. Back in 2008, we saw this happen with Lehman, but Lehman was one bank. Today, the entire shadow banking system the private credit funds, the institutional asset managers, the pension funds that piled into risky yield is facing the same math. And they're all trying to sell the same things at the same time. That's the bomb exploding. Not a single default, a cascade of forced selling that feeds on itself. From my desk at JP Morgan Chase, we stress test for these moments constantly. We ask the ugly questions. What happens if liquidity dries up overnight? What happens if the bond market freezes? What happens if our counterparties can't pay? Most of Wall Street stopped asking these questions years ago. They got comfortable. They forgot that markets have memories. They forgot that what goes up because of easy money must eventually face the gravity of reality. This is what happens when you get comfortable. This is the wake-up call. And it's just getting started. The bomb is detonated. The shockwave is spreading. And now, in the aftermath, the real war for your wealth begins. This war isn't fought on the floor of the New York Stock Exchange. It's not fought in the boardrooms of BlackRock or the trading desks of Goldman Sachs. The real war is fought entirely inside your own head. And most people lose this war before they ever make a single trade. They lose because they confuse motion with action. They lose because the ancient part of their brain, the part designed to spot predators in the grass, cannot tell the difference between a market correction and a saber-toothed tiger. So they freeze or they flee, and either response at the wrong moment can wipe out years of discipline, saving, and investing. Let me tell you what's happening in the minds of millions of investors right now. They're watching their portfolios drop. They're doing the math. They're calculating how many months of salary they just lost. And the pain is real. I'm not here to minimize it. When you work for your money, when you sacrifice and save and build something over years, watching it evaporate on a screen feels like a violation. It feels like the system is rigged against you, and in some ways it is. But here's what the system relies on. It relies on you panicking at the worst possible moment. It relies on you selling at the bottom so that someone with cash and patience can buy your assets at a discount. The game is brutal, but it's simple. The wealthy get wealthy during these moments because they have the liquidity to buy when everyone else is forced to sell. The middle class gets squeezed because they have the opposite problem. They need liquidity exactly when everything is falling. Back in 2016, when the markets were jittery over Brexit, I watched this pattern play out in real time. The morning of vote, when it became clear that Britain might sexually leave, the futures market plunged, panic selling it before the New York opened. People called their brokers, clicked their sell buttons, locked in their losses before noon. And then something interesting happened. By the close of trading that day, the markets had recovered a significant portion of the losses. By the end of the week, they were higher. The people who panicked and sold at the open, they locked in permanent losses. The people who did nothing, who sat on their hands and waited for the dust to settle, they got their money back and then some. I didn't move during that day, not because I'm brave, not because I have some crystal ball. I didn't move because I've learned the hard way that the market's first reaction is rarely the right reaction. It's emotional. It's mechanical selling by algorithms. It's margin calls forcing liquidations. The first move is almost always wrong. I wait for the second move. I wait for the market to show me where the real bids are, where the real support lies, before I make a decision about my own capital. This brings me to the most important concept you need to understand right now: cash. For years, you've been told that cash is trash. You've been told that inflation will eat your savings, that you must be fully invested, that sitting on cash means you're missing out. That advice came from people who make money when you trade, when you buy their funds, when you stay in the game no matter what. Let me tell you something different. In a liquidity crisis, cash is not trash. Cash is oxygen. Cash is the ability to sleep at night. Cash is the ammunition you'll need when the panic selling reaches its peak and real bargains appear. I'm not saying you should be 100% in cash. I'm saying that the people who weather these storms best are the ones who maintain dry powder. They keep a portion of their portfolio in things that one T-drop 50% when fear hits. They keep money in money market funds and short-term treasuries, in plain old bank deposits that aren't going anywhere. And when the forced selling reaches its climax, they have the ability to step in and buy assets from people who are selling for the wrong reasons. Why are people afraid of cash right now? Inflation. Everyone's terrified that the dollar in their pocket will be worth less tomorrow, and that's a valid concern over the long term. But here's the psychological trap. Inflation doesn't happen overnight. A market crash does. You can lose 30% of your portfolio in a week. You can't lose 30% of your cash in a week to inflation. Inflation is a slow burn. Market crashes are a fire. You need water right now, not 5 years from now. Cash is that water. It gives you options. It gives you the ability to not be a forced seller. It gives you the ability to be a buyer when everyone else is desperate. Now let's talk about what the big institutions are doing right now. This is critical because understanding their behavior helps you understand why prices are moving the way they are. The term you need to know is degrossing. When a hedge fund or a large asset manager degrosses, they're not selling because they think the assets are bad. They're selling because they need to reduce their total risk exposure. Think of it like a ship taking on water. You throw cargo overboard, not because the cargo is worthless, but because keeping it threatens the entire vessel. That's what's happening across Wall Street right now. Funds are selling perfectly good assets, profitable companies, solid bonds, because they need to raise cash to meet redemptions or to lower their leverage ratios. This creates artificial selling pressure. The assets aren't falling because the companies are failing. They're falling because the holders are forced to. This is where the psychological trap catches most retail investors. You see a stock you own dropping 10, 15, 20%. You assume something is wrong with the company. You assume the fundamentals have changed, but often nothing has changed except the ownership structure. A large holder got a margin call. A fund faced redemptions. An ETF had to rebalance. The stock has fallen for technical reasons, not fundamental reasons. And if you sell into that weakness, you're selling to someone who understands the difference between technical selling and fundamental deterioration. You're selling to someone who will hold that stock and watch it recover when the technical pressure abates. I've seen this pattern my entire career. A trader holds a losing position because the pain of realizing the loss is worse than the hope it will come back. It's not rational, it's biological. Loss aversion is one of the most powerful forces in human psychology. Studies show that the pain of losing is roughly twice as powerful as the pleasure of gaining. So when you're down 20%, the thought of selling and making that loss permanent feels unbearable. You'd rather hold and hope even if the evidence suggests the decline has further to go. But as CEO of JP Morgan Chase, I can tell you something the market won't tell you. The market does not care about your pain point. It doesn't know you're down 20%, doesn't know you're down 20%. It doesn't know you're hoping for a rebound so you can break even and get out. The market will test your pain point until you break. It will push you to the point where the fear of further losses finally exceeds the pain of realizing the current loss. And that point, that moment of capitulation is exactly where the smart money starts buying. This is why you must detach your ego from the ticker. Your portfolio is not a repo. Write card on your worth as a human being. It's a collection of assets that will fluctuate in price. The price today is not the value tomorrow. The only thing that matters is whether you're a forced seller. If you don't need the money today, if you can wait out the storm, you have an advantage that the institutions don't have. They have to sell. You get to choose. Don't give away that advantage because your emotions tell you to make the pain stop. The pain will stop on its own when the selling exhausts itself. And when it does, you want to still be in the game. So the smoke is clearing. The forced selling is peaking. The headlines are screaming their loudest. The amateurs are frozen in fear, have already sold in panic. The institutions are degrossing, throwing anything liquid overboard just to stay afloat. This is the moment. This is where the gap between those who understand the system and those who are victimized by widens into a canyon that most people will never cross. This is where wealth is transferred from the impatient to the patient, from the emotional to the disciplined, from the many to the few. And the only question that matters now is simple. Which side of that transfer are you going to be on? If I were sitting where you're sitting right now, watching my portfolio, feeling that mixture of fear and uncertainty, here's what I would do. Not what I would tell a client to do, not what I would recommend in some theoretical sense, what I would actually do with my own money, my own family's future, my own peace of mind. First, I would stop asking the wrong question. The wrong question is this the bottom? Nobody knows where the bottom is. Anyone who tells you they know is either lying to you or lying to themselves. The bottom isn't a price level, it's a psychological state. It's the point where the last seller has sold and there's nobody left to panic. Can't predict that point with a chart or an algorithm. You can only recognize it after it's passed. So stop trying to catch a falling knife. The knife will fall until it hits the floor. Your job isn't to catch it. Your job is to be standing nearby with your hands in your pockets, ready to pick it up after it stops moving. The right question is this. Am I positioned to wait out the storm, and do I have the firepower to act when the storm passes? That's the question that separates survivors from victims. That's the question that forces you to look at your portfolio honestly without the rose-colored glasses of hope or the dark lenses of fear. Look at what you own. Ask yourself, will this company exist in 5 years? Will this asset generate income or appreciation when the panic fades? If the answer is yes, then the current price is just a number on a screen. It's not a loss until you sell. If the answer is no, if you own something that was riding purely on speculation, on cheap money, on stories instead of fundamentals, then the current crisis is doing you a favor by exposing that reality. Get rid of it. Take the loss. Learn the lesson. Move the money into something that will survive. This is what I call the barbell strategy, and it's how I think about positioning in times like this. On one end of the barbell, you have safety. Cash, short-term treasuries, things that won't disappear when fear spikes. This isn't exciting. It won't make you rich overnight, but it will keep you in the game. It will let you sleep. It will be there when you need it. On the other end of the barbell, you have high conviction, long-term assets. These are the companies with strong balance sheets, pricing power, durable competitive advantages, the ones that will survive this crisis and emerge stronger on the other side. Right now, many of them are on sale, not because they're broken, but because their owners are forced sellers. The middle of the barbell, the stuff in between, that's what you ignore. That's the mediocre companies that boomed in the bubble but will struggle in the reality. That's the risky debt that promised high yields but can't deliver when cash flow tightens. Stay away from the middle. Put your capital on the ends. Let me give you a concrete example of how this thinking works. Back in late 2008, when the financial system was genuinely melting down, I watched investors make two different kinds of mistakes. The first group panicked and sold everything, including shares companies like Apple and Microsoft that had massive cash balances and dominant market positions. They sold at prices that in hindsight look ridiculous. The second group made a different mistake. They tried to catch falling knives. They bought Bear Stearns on the way down. They bought Lehman on the way down. They bought things that were not just cheap but broken. Both groups lost money. The ones who did well were the ones who waited. They kept their powder dry. They watched the failures happen. They let the system purge the weak. And then when the selling finally exhausted itself, they stepped in and bought the strongest companies at prices that made no sense except for the fact that everyone else was terrified. This is the discipline I'm talking about. Not about being the smartest person in the room. It's about being the most patient. It's about understanding that markets are emotional, that prices overshoot in both directions, and that your greatest advantage is the ability to wait. The institutions can't always wait. They have redemptions. They have margin calls. They have quarter-end reports to worry about. You don't. If you're an individual investor with a long-time horizon, you have something that the professionals envy, the luxury of time. Don't trade eye. Tee away for the illusion of action. Now let's talk about the psychological shift that needs to happen if you're going to get through this. You came to this channel, you're watching this video because you want to get better, you want to understand the system, you want to crack the code. Here's the truth that most financial influencers won't tell you because it doesn't sell products or generate clicks. The code isn't a trading algorithm, it isn't a secret indicator, it isn't a newsletter or a subscription service. The code is discipline. It's the ability to watch your neighbor panic and say, I will not join you. It's the ability to see a 20% drop in a stock you own and ask, is the company 20% less valuable than it was last month? Or is the price just reflecting temporary selling pressure? It's the ability to sit on your hands when every instinct tells you to do something, anything, to make the pain stop. I made this mistake when I was young. I thought trading meant I thought activity equaled progress. I remember a trade I made in the 1990s and a position that went against me. Instead of stepping back and reassessing, I doubled down. Then I doubled down again. I was going to prove I was right. I was going to force the market to agree with me. And the market, as it always does, punished my arrogance. I lost money that I couldn't afford to lose, and I lost something more valuable. I lost months of my life to stress and regret. That lesson cost me, but it taught me something permanent. The market doesn't care about your opinion. It doesn't care about your analysis. It doesn't care about your hopes. It only cares about the balance between buyers and sellers. When sellers overwhelm buyers, prices fall. It's that simple. And fighting that reality with ego instead of acceptance is a guaranteed way to lose. So here's what I want you to take away from this. Not financial advice. I'm not your advisor. I'm not in your situation. I don't know your specific circumstances. But here's how to think. Here's the framework. This isn't the end. It's a correction. It's the market's painful way of telling us we got ahead of ourselves. We priced in too much optimism. We assumed the easy money would last forever. We forgot that cycles exist. And now the cycle is reminding us The question isn't whether the cycle will turn again. It will. It always does. The question is whether you'll be positioned to benefit when it does. I've seen this movie before. I've seen the panic, the despair, the declarations that this time is different. And then I've seen the recovery slow at first, then faster, then eventually a new bull market that makes new highs while the people sold in panic watch from the sidelines. The ending is different for those who prepare. The ending is different for those who understand that markets are not rational in the short term, but are remarkably rational over the long term. The ending is different for those who keep their heads when everyone around them is losing theirs. Look at your portfolio tonight. Not to panic, but to assess. Do you have cash? Do you have dry powder? Do you own things you truly believe in? If the answer to any of those questions is no, start fixing it, not in a panic, but with intention. Sell the things you don't believe in. Raise some cash if you can. Make a list of the assets you want to own if prices were 20% lower than they are today, and then wait. Wait for the fear to peak. Wait for the forced selling to exhaust itself. Wait for the moment when the headlines are so terrifying that buying feels like insanity. That's the moment. That's the opportunity. This is Jamie Dimon. I've spent my life in this business. I've seen the good times and the bad. I've made mistakes and I've learned from them. And I'm telling you right now, with everything I know, that this moment will pass. The sun will come up tomorrow. The economy will eventually recover, and the people who understand that, who act on that understanding instead of reacting to their fear, will be just fine. Be prepared, be patient, be disciplined, and whatever you do, don't let the panic of the moment make decisions that your future self will regret. Thank you for watching Dinology. If this video helped you see things more clearly, share with someone you care about. They're probably struggling with the same fears, the same questions. Give them the gift of understanding, and I'll see you on the other side.